So, welcome back to our channel. This is another small video on value-added tax. It's another exercise case. Value-added tax is usually something where you need to be very, very well trained in real life because this is the one thing which you need probably every day in a firm, and you don't have the time and money to ask a tax advisor for all these things. Or if you are a tax advisor, you have to be able to answer all potential questions. So you have to be very, very well trained, and that is why we have now exercise case number 23 to think about. Well, so let's go on. What will the case bring? Here it is. Here is what we have to do. B from Bonn took part in a trade fair in Paris, France. And during his stay in Paris, he needs some goods to show them to the visitors of the trade fair. So he orders them. Naturally, he orders them from home, somewhere from Germany. The German producer sends them to Paris and charges B with the price of 10,000 plus 1,900. That's 11,900. Now that's not everything what happens here, because at the end of the trade fair, B or his employees regard it as too complicated to take all the exhibited goods back to Germany. And so, in order to save transportation costs, he sells them off to visitors of the trade fair at the last day of the trade fair. The customers take the exhibits home, and the price charged to them was 6,000. That is what they actually pay. So, the gross price, if VAT happens to occur. Apart from that, now B got an order from a customer F from France, whose VAT number from France has correctly been communicated to B. And now, on request of that customer F, B sent that product in question to a production site of the customer in Munich, Germany. The price agreed upon was 20,000 plus VAT, if any arises. And there might also be a variant, which we have to talk about later. On request of F, B sent the product not to Munich, to a production site of F there, but to Munich to a customer, M of F, who lives there. So that's how it begins. And now we have to go to what has to happen next. You see here, our first line reminds us of we will have to make some preparatory steps, and we have already learned that, well, one event, two events, three events, every event has always to be reviewed independently and on its own, so we can spend our time now by entirely concentrating on event number one. He orders goods from Germany, which are sent to him in Paris. So to see who does what for whom, we have a German firm here, which is the seller. We have B from Bonn as the customer. We have the transaction. They order some goods. We don't know which ones. And 11,900 is paid. And the movement of the good is from Germany to Paris. So that shows us it's a cross-border case in the EU. And that means that we have to apply the rules which we have learned for cross-border deliveries in the EU. You probably remember them. There was a three-step testing scheme. The first step was, is the customer an entrepreneur? If so, the customer should pay the tax in the country of destination. And that's indeed the case. Yeah, B from Bonn is the owner of an enterprise. And the rules don't ask if the customer is an enterprise owner from that country of destination. The rules just ask, is the customer an entrepreneur? And if so, we have a treatment as inter-community acquisition for the buyer, and for the supplier, it's a tax-free inter-community delivery in his own country. Okay, so as step number 1 is fulfilled, we can forget about step number 2 and step number 3. We have already found the way how the solution must be construed. Here we are evidently asked to deal with B's solution. However, if it's not sure what you have to assess or what you have to examine, then I would always recommend you to deal with both sides, so to clear the treatment of the seller and the buyer. I would recommend then to begin with the treatment of the buyer, because to treat something as an intra-community delivery, you must already know if the buyer has to pay acquisition tax or not, so it's a good idea to concentrate on the buyer first. Okay, so our first step will be, let's have a look how B from Bonn is treated here. The first step is taxability, and we have to test number 5 now, because number 1 would be a delivery. The customer doesn't deliver, so an acquirer can only be listed in an extra number 5. So we have to test if it's an intra-community acquisition, and later if it's taxable in the inland, or in which inland. So intra-community acquisition is defined in paragraph 1a. Number 1, first requirement, the good in question goes from one country to another, from Germany to France. That's fulfilled. Number 2, the customer is an entrepreneur and acts as such and not as a private person. That's B from Bonn. He is an entrepreneur, that's sure. And the deliverer, that's A, the German firm, is an entrepreneur and is not treated as a small entrepreneur. So it's indeed relevant for value-added tax. So conclusion will be, this is an intra-community acquisition. Now I just tell you this, and you know we should always look things up, because in taxation you can't and you should not trust anybody, even if you have a look. If you trust somebody as an expert, it could be that the law has been changed in the meantime, or that you remember something wrongly. So let's have a look to the text. And surprise, it indeed seems to be the case when we have a look here to 1a of the Umsatzsteuergesetz of the German Value-Added Tax Act. We see the definition of an intra-community acquisition in paragraph 1a, subparagraph 1. An intra-community acquisition of a good is given, or is given if the following conditions are met. First, the good goes from the customs territory of one member state into the customs territory of another member state. That's the case in our case. The acquirer is an entrepreneur who acquires for his enterprise. And number 3, the delivery is made by a supplier who is an entrepreneur and for consideration, and the supplier is not a small entrepreneur. So that's indeed the proof that it's an intra-community acquisition. We might also have a look already to the question if it is in the inland. So we need for this not the place of delivery, because it's not a delivery here, but the place of acquisition. So let's have a look to table of contents. And it's paragraph 3d there, which we have to test. The intra-community acquisition of a good is effectuated in the territory of that member state in which the good is located at the end of the dispatch, transport, or movement of the good. So that's France. However, if the acquirer uses in front of the deliverer a value-added tax number which has not been issued to him by the right member state, then the acquisition is, and you must add in the back of your minds the word additionally, deemed to have taken place in that case, in that state where the number was taken from. So that's great. So we have here potentially two places of acquisition. And we will have to test these rules with regard to our case data. So let's go back and inspect our case data for the place of acquisition. Now, indeed, what's a clear case is that the good goes to France. So indeed, sentence 1 says place of acquisition is in France. However, B should use for dealing with the whole matter a French value-added tax identification number. Now we can reasonably suppose that B only has a German number until now, because otherwise we would have been informed about that. So if, in case if B used a German number, then the place of supply is additionally also in the country where the number came from. So that would be Germany. So that leads us to an additional conclusion, which says, okay, until the usage of the wrong number is corrected, that was 3D sentence 2 later, the place is in the country of the number, as long as you cannot prove that you paid correctly in the right number, in the right country of destination. So if B here uses his German VAT identification number, then the acquisition is additionally taxable in Germany as long as B cannot prove to the German authorities that the whole maneuver has been correctly declared and taxed in France already. So we have an intra-community acquisition taxable in Germany and in France. Here you see Albert Einstein, time and space is relative. Yes, and here you can even have one single event legally happening at the same time at two different places, in Germany and in France. So the world is full of miracles. Let's just accept this, because this 3D sentence 2 rule is a rule to avoid cheating or mistakes or a malfunction of the whole VAT system. So it's necessary, and so we just apply it. Tax exemption is the next question. The only thing you need to remember here constantly is that the tax exemptions here cannot be found in paragraph 4, but that there is a different rule for B, which is a list of the exemptions applicable for intra-community acquisitions, and none of them applies. So our conclusion is the transaction is fully liable to tax. However, let's look it up to be sure. Yeah, and here is for B, and indeed the inter-community acquisition of goods is free of tax and only free of tax in 4 events. If the goods named in paragraph 4 number 8 letter E and number 17 letter A are delivered, or paragraph 8 number 1 or 2, so very rare cases. Number 8 has something to do with financial transactions. Number, I believe it's means of payment. Number 17, letter A, is human blood and human organs. Or 8.1 is something having to do with international traffic by ships or aircraft. Of the goods named in paragraph 4, number 4 to 4b, and certain things mentioned in number 8, financial transactions, related things, under the circumstances named in those provisions. Number 3, of goods which can be carried into the inland without importation value-added tax from a third country. They can also be brought over the border from another country into the inland without acquisition tax. And number 4, goods which are imported from, or imported is now rather untechnical, which are acquired from another member state, but then directly re-exported to another country and therefore tax-free under paragraph 4, and still entitling the supplier to input tax refund or deduction under paragraph 15.3. So very, very rare cases. And in our case, where the goods go to a trade fair and are used there, exhibited there, none of these exceptions applies. So we know the transactions are evidently liable to tax, and that is enough now, and we can go back and think about the right solution again. Now, it's probably not a surprise to you that our next testing step must be the tax base. And I hope that you already know by heart that paragraph 10, section or subparagraph 1, sentences 1 and 2 say the tax base is usually the net amount, and that is defined as everything which the entrepreneur gets from the customer or from others for the delivery minus the VAT amount contained therein. He gets 11,900 and VAT contained therein is 0, because when we have an acquisition, then the acquirer has to pay the tax. So the acquirer has to pay the tax on top to the price which he pays to the deliverer. So the price here cannot contain value-added tax, at least not from the buyer's perspective. And if everything works correctly. So yeah, that's why the 11,900 is here net tax base, although it sounds so much like a gross tax base because it's just 119% of 10,000. However, the application, the legal definition clearly shows what's going on. The tax rate and the tax, we assume that, or we can only say in France, the French tax rate for the goods in question. We don't know the details. In Germany, it will be 19% in all probability, because we have no indicator that the goods could have been taxable only with 7%. Here my case data is naturally a bit inexcusably low or imperfect, because I just said he buys some goods, and that should be better. However, let's assume it's 19%, so we end up with 2,261 euro. Let's go to the formalities, and I think let's have a look here. Taxpayer B, the acquirer is the taxpayer for an acquisition tax. That sounds convincing, but we should test it naturally if we found the right reference to the legal text here. Yeah, and to say it brutally and shortly, you find here indeed in 13A1 number 2 that in cases of 1.1 number 5, so in case of intercommunity acquisitions, the taxpayer is the buyer. Everything else would have been surprising. The important thing here is probably not the statement, but where you can find it if you need to give a proof that you know the right point where to look for it in the Tax Act. Let's already try to find out also the rules on the arisal of the tax, or probably as the English would call it, the tax point or tax point of time. So that is in paragraph 13 usually. And let's have a look there, 13.1 number 6. It's rather hidden somewhere in the middle. In case of an intra-community acquisition, then the tax arises, or the tax becomes due at the moment when the invoice is issued, but as people then might play that game never to issue an invoice to save the tax, there is a latest date. The latest date when the tax arises, or the latest potential tax point, is at the end of that calendar month, which follows the month of acquisition. Yeah, so I believe we don't have any data in the case, but we should look it up and make the remark which shows that we examined this. So paragraph 13a, that was indeed true, and the arisal of the text or the text point can also be noted down as we sketch this, or as we, can we say sketched? I don't know. I hope you understood me. No peculiarities concerning invoicing because acquirers don't issue invoices. Declaration duties here shall be fulfilled in France and in Germany if the German VAT number was used. However, if they know about their French declaration duties, then they will have a tax identification number from the French afterwards, and they probably also can apply for a VAT identification number then, and so can retroactively remove the German taxability. Anything special apart from the two places of acquisition? No. Input tax claims or deductions can be successfully made for the French acquisition tax, 15.1 number 3, in the French variant naturally, because you can't force the French to give an input tax refund or deduction based on German law. Naturally, you need the corresponding rule in French legislation. Now, in Germany, you cannot claim back the 3D sentence 2 tax because that can not be deducted as input tax, but you can only recover it by proving to the fiscal authorities of Germany that you correctly declared and paid the acquisition tax in France. Yeah, okay. Now, if you can also deduct the 1.9 thousand euro which were charged by you in the invoice issued by the German deliverer, that's something which we shall discuss immediately afterwards. So in the next part of that case. Now, we spoke about the treatment of the acquirer. Now, for the sake of completeness, let's talk about the treatment of the deliverer. That's A in Germany, the German firm. Two. For the German deliverer, let's ask if there is taxability in play, and we have to test here one number 1 because who sells is somebody who delivers. So number 1 is to be tested. Number 5 is out because who sells doesn't acquire. It's a delivery because the ownership or the position like an owner in the tangible good is changed. The place of delivery is where the movement of the good towards the customer begins, 3C6, sentence 1. And the whole thing is done by an entrepreneur who also acts as such and acts for consideration, so it's taxable in Germany in under 1.1 number 1 USDG. Is there a tax exemption, especially is there a tax exemption for an inter-community delivery? Let's test the rules in 6A. 6A1 number 1, the good goes from one member state to another, that's France. Number 2, the acquirer is an entrepreneur. Number 3, the acquirer is subject to acquisition tax in at least one other member state. Yes, that is true because that's France. 6.1 number 4, the acquirer did not use the VAD identification number of any other member state than during the transaction. Because B bought, that was our assumption under his German number. So number 4 is not fulfilled, and so one condition for an inter-community delivery, which is tax-free, is not fulfilled. Note this will change when B does correctly his taxation in France and then contacts A to communicate to A his now correct French identification number. Then number 4 can later be fulfilled and the present treatment can be changed to then it's tax-free. But up to now, number 4 is still missing, so inter-community delivery cannot yet be proven by A, and so it's taxable, or liable to tax, sorry. Later, it will become tax-free when number 4 can be supplied by the customer. Until then, we need to find a tax base. And if it's liable to tax, then the tax base for the delivery is everything which A gets, that 11,900 from the customer, minus the tax amount contained therein, that's now 19, so 10,000. And that's strange, yeah? Due to the error, the acquirer has to pay acquisition tax, and the deliverer has, at least until the delivery has been proven to be tax-free, has then still to pay VAT in his own country. So twice. Oh. Or here even 3 times, because once acquisition tax in France, once in Germany, and tax for the delivery in Germany. So we have here the maximum chaos, which is potentially imaginable. Well, tax rate and tax 12.1, 19%, so 1900 if there is no 7% good in play. The formalities are the taxpayer, that's 13A, number 1, the deliverer, the entrepreneur, yeah, that's clear. The arisal of the tax or tax point, that's when at the end of that preliminary declaration period during which the delivery was made, 13.1, number 1. And the invoice is at the moment correct, but should later be corrected to tax-free when the missing information, the missing French VAT number, is supplied by B. Then you need to declare it in the recapitulative statement later. When it's clear that it's an intra-community delivery, you have to type into the automatic information exchange system of the EU states the VAT identification number of B from Bonn, but the French one, and the net amount of the delivered goods. Now, then the 1900 are really due in the beginning, so it's not a 14C case. It's not illegal or overcharging VAT, because for the deliverer there is no proof of tax exemption, so it's indeed liable to tax. But later, when the proofs come in, then the delivery becomes tax-free, and then to keep that invoice with the 11,900 uncorrected outside the enterprise, that leads them to a 14C case. So probably later A will have to send B a letter where he says the price is now 11,900 net, or even the price is later adjusted to 10,000 as was originally meant, and A refunds to B the additional 1.9. So yeah, input tax claims, A, it does a tax-free intercommunity delivery. However, in spite of the tax exemption, A keeps the right to deduct input tax for all the raw material, other things which have to do with this delivery. And the customer B has no right to deduct the 1900, even in the beginning when the invoice was, when the money still was due, because there is a rule in EU law which also influences the interpretation of national law here, that an input tax refund is not possible for transactions cross-border which could have been treated as tax-free and which were only not treated as tax-free because somebody forgot or missed some proofs. So that's the first event here. And now it's clear what we do after the first event. We go to the second event, and so let's have a look at this. At the end of the trade fair, B sells off goods to French visitors of the trade fair. So let's have a look what that means. Analyze the situation. We have B from Bonn selling to French customers. Here's the sale. 6,000 are paid by the French. The goods go away from Paris to the customers somewhere in the rest of France, potentially Paris too. Why does the movement of the good begin at Paris? Because the movement of the good towards a customer cannot begin before a customer exists. And so when on the last day of the trade fair one sells to customers going by there, these customers only become customers at the moment when the contract is concluded. So before the goods have arrived at Paris, they were not transported towards a customer. They were just transported by B to the place where B needed to use them for his trade fair things. So movement towards the customer only began in Paris. That means it's not an inter-community case. So the French customers can give us masses of VAT numbers. That all makes no sense. So the goods do not cross the border. It's an intra-state case, purely domestic case in France. So taxability, number one, it's a delivery. 3.6, the place is Paris, not taxable in Germany under number one, but in France. And the further treatment of the affair will go as French law prescribes. So probably no tax exemption under the French parallel to paragraph 4. The tax base will be the net amount and the tax rate will be the French rate for these goods, whichever they are. Declaration duties will arise in France. So what can especially not be used is the OS scheme, the one-stop shop scheme, because that is only meant for distance selling sales to private customers cross-border in the EU and in special other cases, but not in a national case, purely national case inside France. So here they will have to take French tax declaration. Yeah. Next case, or no, next event in the case. Again, what happens? We have B from Bonn delivering to F from France. The good, however, is delivered from Bonn to Munich, so no cross-border transaction. An intrastate delivery within Germany. So to test this number one for B, it's a delivery 3.1. The place is in Bonn where the delivery begins, because we assume that the good is sent from Bonn to Munich. So everything's taxable here. We have no tax exemption under paragraph 4, especially no inter-community delivery, so fully liable to tax. Tax base is here 20,000 net, because the price was 20,000 plus VAT. 19% on top is 3.8. Taxpayer is the deliverer, that's B. Tax arisen when the delivery was made at the end of the next preliminary declaration period. Invoicing, nothing special, a regular gross invoice. Declaration duties, everything as usual. Peculiarity, as nothing peculiar, which is not covered by the usual testing scheme, shows up here. Input tax claim, F can deduct input tax if he uses these goods for his business. He probably does, because in Munich he uses them at a production site, and so he can deduct them here. Next question remaining is the variant case. On request, F delivers, B delivers not to F personally, but to M, the customer of F, situated in Munich. So let's think about that too. So in that variant here, let's again analyze what happens, because if you have a variant, then you have to begin from zero again, from scratch, because then the case might be completely different, and indeed it is. Let's first look who has a contract with whom. We have here B having a contract with F, and so he has to hand over ownership to F, and then F has evidently a contract with an own customer in Munich. So we have two transactions, and plain logic says B must hand over ownership first to F in France, or from France, before F can pass over the good to M in Munich. That's clear. Now B sends the good to another location, namely to Munich. Why? The transport of the good from Bonn to Munich is in order to fulfill the obligation which B has to F. B sold F a good, so he has to carry it to the place where F wants it to get, and has to hand it over to F, or if F is not present, but F says, you can hand it over to somebody else who is my representative for that transaction, who gets the power to act for me during reception of that. Is it reception? I hope. Reception of that good. Then you see that what happens here when B sends the good from Bonn to Munich is simply the execution of the contract with F. Customer can say where he wants the good to be sent to, and to whom the good shall be delivered or handed over. So who has the power to represent him during the acceptance of the good? Now, when that is done, then, only then, not earlier, F can begin, now being the owner and having the good in hand, represented by somebody else, but legally it's him. He can now transfer ownership to the next person. So the good is at that time already in Munich, exactly at the address of M, and then ownership can be transferred to M. That is probably done in a fraction of a second, and the good does not need to be moved because it's already at the address where it shall also end up under contract number 2. In that case, we have two transactions, and here that's first thing about the transaction B to F. The good goes from Bonn to Munich. Taxability is evidently fulfilled. We have place of delivery in Bonn, so taxable in Germany. There is no tax exemption because, especially not 6a, because the good does not leave Germany. No cross-border transaction. Tax base is 20,000 as agreed upon. Tax rate 19%, 3.8. Taxpayer is again B. Tax arisal, tax point is the end of the preliminary declaration period, blah blah, during which the delivery is made. Invoicing is normal, declaration duties, nothing special at all. F can deduct the input tax under 15.1 number 1, naturally in a German tax declaration, because not in a French one. And the transaction F to M, that's taxability, yes. F is an entrepreneur, acts as such, and for consideration, performs the delivery. Place of delivery is without movement, so in Germany, so it's taxable in Germany here, and we have, I believe, no additional information on that. So we can, however, presume there is no tax exemption under paragraph 4, probably. The tax base is not given here. We have no information. Tax rate is probably 19%. Taxpayer will be F. Tax point is 13.1 number 1, end of the declaration period. Invoice must be written according to German rules by F now, because it's an intra-German delivery which causes a tax. Declaration duties must be fulfilled to the German authorities, not to the French one, because the place of delivery is here in Germany. Nothing special apart from that. And input tax claims M can, in all probability, claim back the tax if M also is a business customer, so an entrepreneur. And yeah, I believe that's it. Yeah, I hope that gave you a good impression of a small case can look like. And you saw sometimes that takes some time, at least if you read it out. In reality or in an exam, you will probably expect that you are able to do this in a quick time. So practice. Yeah, thank you very much for watching the video. Until next time, have a good day and goodbye.